It's been good to see. I mean, your Twitter's been growing really well, actually.
Twitter's been hot. Twitter's been hot, man. Like I have to say, LinkedIn has been struggling. I don't know what's going on with LinkedIn. Like they changed something on the algorithm, but Twitter's been hot, and I probably should have started on Twitter a little bit earlier.
Yeah. It's your personal flippening right here. I mean, you started hot on LinkedIn, but I think that was a good place to start because that's where you kind of broke through, right? And you really built a brand for yourself. And that's where you kind of built an edge in the crypto analyst space, which there are a lot of people tweeting about crypto related analysts on Twitter, but no one was really doing it on LinkedIn. And then you started doing it there. And now you're expanding to Twitter and things have flipped. It's kind of funny.
That was kind of the thinking. It was kind of a green pasture over on LinkedIn. Nobody was over there. So it was kind of a nice like place to start. I would say that if you look at the comment sections on LinkedIn versus Twitter, they're a little different. But I'm loving the engagement that we've been getting on Twitter, so it's been fun.
Yeah, I can imagine from like an analyst perspective, posting on Twitter and the conversation engagement you get there is a bit more thought-provoking in a good way versus LinkedIn, which is just more answering the most boilerplate basic questions and critique that you get from non-crypto people. So different worlds.
It's totally different. It's almost like being in a corporate office versus like a startup where people like are a little bit more direct, and that's what you want, honestly. Like there is so much value in putting stuff out on Twitter or LinkedIn for the feedback. I want people to disagree with me. I want to hear opposing thoughts. A lot of times I'll say who has a contrarian take when I put stuff up because I want to know what I'm missing. So yeah, Twitter's been great for that. And yeah, I always say the DeFi report's like sort of unique in that, and for like a crypto sort of research publication, because we sort of like organically grew on LinkedIn first, which has a little bit more of that corporate audience. And now I'm starting to go a little bit more crypto native as well. So.
That is good. And like I said, Twitter's taking off. You put out a great post about the markets and your take on that just a while back. I want to speak about it soon. I think it might have even been one of your most viral posts ever. So congrats on that one. But maybe before we go into that, welcome back everyone to The Signal. We took a bit of a breather with Mike, enjoyed summertime. I was up in high altitude. I think you were spending some time golfing. And now we're back in the trenches, so to say. About a month back, one thing I want to speak about here, we recorded the episode about Robinhood and just kind of a speculative thing about how they could be approaching the crypto space. And funny enough, I think the last week, I've had this feeling that Vlad, the CEO of Robinhood, has kind of gone on this media tour almost, been on a couple of podcasts and has been speaking a lot about Robinhood's approach to crypto. And he started to be very vocal about the fact that, hey, we're currently earning more revenue from trading crypto than equities. And that we're really trying to position ourselves for this new age investor that's coming into the market that cares about crypto and AI and build a platform that really supports that. So I have a feeling that our episode a month back might age quite well.
It looks that way. And I've noticed this media tour as well. I actually watched a little bit of his interview with the guys over at Bankless recently, and one of the questions that they asked him was on that L2, because we talked a lot about, is Robinhood going to launch an L2? It seems very strategic for them to do it. He sort of danced around that question a little bit and sort of, he was focused, he answered it more in, hey, I think their primary sort of like value add is like building awesome interfaces, and that's really where they want to carve out a niche. But at the same time, if you're building really awesome interfaces that are sticky, like if you can like capture fees underneath that as well, you have to think they're looking at it. And I would imagine if he is planning on building an L2, he's probably not going to tell everybody that either, like with competition and things. So yeah, I don't know. I've been watching this as well, and it's very interesting to see. He's definitely been on a bit of a media tour with the crypto space.
Yeah, I really don't see a scenario where they don't start building on-chain products, and the way he's emphasizing the fact that it's much more efficient to build these things, it's much more streamlined to run them from a business perspective. Like for Robinhood, it makes a lot more sense to start building an on-chain backend for everything that they provide instead of just running on servers. So I think our take, when speaking about this token terminal, is that sooner than later we'll see probably an L2 plus stablecoin combo from Robinhood come out, because those are really the two cash cows in crypto right now. So if you launch your own L2 and a stablecoin, that's how you're going to be able to really print money, and your shareholders will be happy.
100%. Yeah, and it's going to be really interesting. I saw something, I think it was coming out from one of the larger banks, and this is like related to stablecoins. And these banks, like, they don't want to see USDC or USDT taking off and like a big network effect around one stablecoin, because that that makes it really difficult for them to enter that business. They all want to launch their own stable. They'd rather have a world where there's hundreds of stablecoins and they're somehow interoperable and fungible, because then they can capture some of those fees as an issuer. It's going to be interesting to see how that plays out. I really think that like regulation is going to determine the winners here, and probably the stablecoin race. I mean, USDC has a big lead here, but I don't know. I've been trying to think through, is the regulator going to sort of do something that allows these banks to sort of catch up, because they're losing right now. So we'll see. Could impact Robinhood too, but yeah, if you have tons of users, you have the interface, introducing something like that is just another line of revenue, basically. So
Exactly. Going to be exciting to see how that develops, and also closely following how Coinbase will react. We'll get back to that in some following episodes for sure. Need to do some more deep dives and maybe even get someone from Robinhood or Base on to speak more. But let's speak about markets here, because I alluded to somewhat viral tweet that you put out that I just pulled up on my screen here quickly. Close to 500,000 views already on this one. Some great discussion around it. You walk through how you currently view the state of the market and why you are not bearish, as neither am I. So do you maybe want to walk through your core points that you laid out here and why you think this got so much traction?
Definitely. And this went out a day or two after, we had a pretty big sell-off with like the Japanese yen carry trade was kind of unwinding, and basically everything flipped. The markets had been sort of, the sentiment I would say was kind of negative for a few months or so on the timeline, especially with people that are in altcoins. And I've been bullish for a while now, and probably got a little out over my skis myself. But basically that big correction made me more bullish. It was like everything that we needed to see happen started to happen. And so basically what I laid out here is like 10 points of kind of the big picture of kind of what I'm looking at. And the first is like Bitcoin, just had its first 33% correction. This is pretty normal in bull runs. The last cycle, I think there were 6 of these, and this is the third one that's over 20%. So maybe Bitcoin's volatility is actually compressing slightly. And so it's not 30% corrections anymore. It's more in the 20 to 30% range. So that was the first sort of like really aggressive one. And, we've seen a few others. Solana corrected 45%. It's had 2 other corrections of 45%. And then Ethereum corrected 38%. And it's had 2 other corrections of 30% plus. So to me, like, really to sort of see like these, like, sort of the next leg of a bull run, you sort of have to chop the market up. Like, you can't just have a straight line all the way up to 100K for Bitcoin. And so this is like a good thing, right? So we kind of need to see these sort of corrections, see the market get scared, people get over their skis. As that played out, funding rates have reset, and I can just share, my screen here to show what that looks like. So this is a chart of futures perpetual funding rate. It's got all the exchanges included here, and we can see that, things got pretty heated in Q1 of this year. This is the green lines. Kind of got to a similar level as like sort of the second leg of the last bull market. So like in the October to November of 21 period. And we can see that it's basically reset back to like normal levels. Actually flipped negative. We just actually flipped like slightly negative there at one point during that big correction. So this is what you need to see. You need to see the traders that are basically momentum investors get out over their skis, get liquidated, kind of reset the market. The open interest got like way out over its skis as well. And so good to see this reset. I think that's like another important factor here in kind of some of this analysis. Along with this, we had the MBRV score has basically collapsed. This is one I'm always tracking as well. And just looking at MBRV, we're down to like 1.47, I believe, was when I read this, in the 1.5 range or so, which puts us at a similar place that we were at in Q4 of last year, November period, as things were improving. So that's nice to see as well. Just this is reset. This was getting a little bit frothy. This is the market value to realized value, just giving me an idea of, the profits that the average Bitcoin holder is essentially sitting on out there. The other factor mentioned, long-term holders. So we saw long-term holders essentially start to take profits, really starting in Q1 all the way out to like mid of Q2. There was like quite a bit of profit taking from long-term holders. They are now stepping back into the market and buying Bitcoin. So this is sort of like the smart money of Bitcoin. I'm always using Bitcoin's data to sort of track these things. And this is Glassnode providing this data. But that's another positive signal to me that, okay, we've had a little bit of a reset. Long-term holders have decided that it's time to start buying again versus selling. So that's another factor. And I mentioned just, overall market sentiment is very negative right now. So we are currently in extreme fear on sort of the sentiment factors. We went into extreme greed, really at the peak of this in towards the end of Q1. So we've kind of totally flipped on this. When I'm looking at this, it's interesting to see that we had periods of extreme greed in the last cycle, like early in the cycle, in like August of 2020. And then, we saw it again in December of 2020 as like Bitcoin really started to move. We later reset to extreme, but then went up again. So that's the question is, are we resetting to extreme fear now just because we had a little pullback in the market, macroeconomics playing into it, and now we're going to essentially reset? I kind of think we are, but these are all the things that I think are necessary for the market to reset and sort of see that next leg of the run. So I've kind of gotten more bullish as everyone else got like really, really bearish. So aside from sort of like these sort of on-chain indicators, the correction, the sort of, funding levels resetting, we've had a lot of selling pressure from the supply overhangs in the market. This is like the German government dumping on, Bitcoin holders. This is Jump Crypto was unloading a ton of ETH during that Japanese yen carry trade sell-off. Mt. Gox distributions. We've got distributions to FTX creditors. We've got the Grayscale Bitcoin and ETH trusts where everybody's moving out of these like really high fee products, and some of them are going into the new ETF products. So there's quite a bit of supply overhangs that have been like worked out, I would say, over the last quarter or so. This is another factor that's making me bullish about what could play out here. The other stuff is more on the macro side. So the Fed, we've talking about this for a while. The Fed is looking like it's going to cut in September for sure. I think that's basically priced in at 100% at this point. And it looks like there's going to be a few more cuts into 2025 now. This is happening at the same time that it looks like the business cycle, like the actual economy, not the financial markets, is bottoming, right? So this is coming from like the ISM indicator. It's below 50. That typically, is when we sort of bottom. And as that goes up, if you kind of chart the ISM to like Bitcoin price, there seems to be a correlation there. So that's a factor here. Japan basically, which is essentially killed off the sell-off related to that carry trade. So that's another factor here. So that has stemmed the tide for now. The other thing is on the fiscal side, the US Treasury is running massive fiscal budget deficits, printing a lot of money. We are in an election year. So, kind of anchoring to that as well. It's hard to have a recession when you're spending that much money into the economy over here in the US. And then of course, Trump has basically endorsed Bitcoin. Senator Lummis introduced a bill for a strategic Bitcoin reserve. We've seen, bipartisan support from Democrats and Republicans for the repeal of the SAB 121 bill. So, and I actually expect that Kamala Harris is going to flip on crypto and start to endorse crypto as well. I think that's obvious that that's going to happen. I don't think she's serious. I think she's just going to say it. But so I think we're going to see that as well as we get farther into the election cycle. And then, we've been hearing about folks over at Bitwise talking about how a lot of these large asset managers like the Morgan Stanleys of the world are now able to tap into these wirehouses and offer like the ETF products to their customers. And so that tap had not even been really turned on. It was really mostly just like retail buying the ETFs. So we may see, more interest from like larger institutions with those two products that are out in the market. To me, like I've done quite a bit of research and analysis on what does it look like when you put like a small allocation of Bitcoin or ETH into a like well-diversified portfolio. And this is not a hard sell for Wall Street. Like if you look at the historical returns, it basically improves your risk adjusted returns. Like there's essentially very little volatility with a small allocation, but you can outperform your 60-40 portfolio. You can outperform S&P 500, NASDAQ with really like a small amount of like increase in the volatility of the portfolio. So I'm pretty sure that Wall Street knows how to sell this stuff. So that's a good thing. And then the last thing here is I'm trying to figure out, is there some hidden leverage in the market that, I'm not seeing? And that was I was trying to get feedback from Twitter on that. I didn't really see anybody come in with anything that I haven't identified, but we don't have BlockFi, we don't have Genesis, we don't have Celsius. This is really where the hidden leverage was, the Terra Luna systemic risk. We do have Athena this cycle, but I would say that they performed very well during that just recent pullback. DeFi performed very well once again. Maybe there's a potential issue with restaking, staked ETH. You have to sort of look at some of the risks there. But that's kind of the rundown. Is basically there's a lot of factors here that are lining up to, I don't think that the cycle's over, essentially. The probabilities point to like it not being over. Doesn't mean that we won't see another leg down at some point here. I think we're probably going to have some chop, and then eventually, the markets sort of climb that wall of worry again. And to me, the setup looks pretty similar to September, October of 2020. That's kind of my take. Like, what are the big risks to this being totally wrong? Maybe if we go into there's a geopolitical conflict, there's things just like escalate or something, and the markets get a scare there. I don't think I could see TradFi selling off a little bit, and crypto would definitely take a hit. But I don't think that's going to throw off the underlying dynamics of everything that I just laid out. Maybe we get a hard landing. I still think that's less likely because of all this fiscal spending that's happening over here. And then the other one is, I think the markets are sort of pricing in a Trump victory, or at least they were. And now it's actually looking, Kamala Harris has made up a lot of ground. And so that's another factor. If she gets in the White House, does that throw off the chances of this bull run extending? Potentially. So I think those are like kind of the other side of the debate here. But yeah, what are your thoughts? Does this resonate with you?
It definitely resonates, because when you lay it out like that, it sounds incredibly bullish. And I mean, not my first cycle, so I think the price action that we've seen hasn't really scared me in any way. I definitely also agree that we're probably somewhere along halfway through a bull cycle right now. Or actually, a thesis that I saw spoken about on Twitter quite a bit was that the bull market hasn't even started, that we're basically just in this kind of pre-bull market type of chop that we saw sometime back in 2019. Kind of like that thesis as well, that we might not actually be in that proper like parabolic phase of the liquidity cycle. So based on the fundamentals, the setup right now looks really solid. And I don't really see a situation where things could change in a way that would stop the long-term growth of crypto. I just feel like you have the monthly active user chart there accompanying your tweet. Those numbers are going up. We have new ecosystems that are gaining a lot of traction. You have, in addition to retail adoption, you start seeing more like retail usage, emerging market usage, but you're starting to see way more institutional usage and like announcements coming through about like pretty significant partnerships and really great companies coming in to build on-chain products. So I'm bullish. That's my takeaway.
Long term, right? We never know what's going to happen like next week, next month, but
exactly.
definitely bullish long term either way. Yeah, the other thing I think I'm looking at here is stablecoins. So like I'm starting to see, basically if you look at the charts of like Tether's market cap or USDC, which is the bulk of stablecoins out there, they kind of went sort of sideways starting around Q2 So like it kind of
Yeah.
just looks like less money was coming into the crypto ecosystem. Those are starting to flip north a little bit now as well. So yeah, it looks like you got it with token terminal here. So those balances started to move up slightly more recently. So that's something to keep an eye on. And I think what we're kind of looking for here, yeah, so you can see, looks like, yeah, we're starting to move up a little bit. And, I think part of the reason that, some people are saying, hey, the bull run hasn't even started is like, there's been a lot of like token unlocks that are going on, and the altcoins have really suffered. And there's been a lot of discussion around this. And I think that we need to get to a point where there's just like way more stablecoin coming in, way more liquidity coming in, that basically just trumps the amount of unlocks that are happening. And it's just really a supply demand thing. And we just haven't really seen that. And I think we haven't gotten to that stage of the bull run just yet. And that's when like probably Bitcoin eventually gets through its all-time high, enters that period of price discovery. And that's when the sort of blow off top typically happens in crypto. So kind of waiting for that to happen. The other thing is like money market funds over here in the US are at like an all-time high. So there's a ton of cash sitting on the sidelines right now. It almost looks like a bubble in cash right now. So that's something to keep an eye on as well. Is just if interest rates start to come down, I think people are going to be like, okay, what I need to allocate some of this into more riskier assets, and I expect a lot of that to go into tech and crypto from there. So yeah, that's I guess the market update, and yeah, we'll continue to monitor.
Yeah. On this tweet, why do you think it went this viral? Were people generally agreeing with you, or was this like a contrarian take and you got a lot of backlash?
I think it went viral because it was like hopium,
Ah,
and it happened at a moment where everybody needed some hopium. And I think it was easy for people to sort of follow the 10 points and be like, okay, this actually makes sense. I think that's basically what it was. Is everybody's pretty fearful,
mhm.
and that was a hopium tweet. So I think that's probably it. But there's definitely some contrarian takes in the comments there, but I didn't see any. Most of the people that were like, "No way, this is happening," are saying, "Well, TradFi is going to run into trouble, and crypto will suffer if the TradFi markets do." And I agree with that. Like, if TradFi goes down another 10-15%, I would expect crypto to drop
Mhm.
probably double that. So that could happen, but I don't think it structurally changes sort of the longer term setup. There were some comments about geopolitical conflict that could throw this off, but it
Mhm.
was mostly support, I would say.
Yeah.
So yeah.
Definitely looks like it. And I just have to say that I love the fact that in terms of like general fundamentals based indicators, one of them is sentiment towards bankless and how much people have the pitchforks out
It's
and attack them.
hilarious. Yeah,
That is,
I've seen people literally, and this is like probably a bottom indicator for ETH. I've literally seen people like saying that like the reason ETH is struggling is because of bankless on Twitter. So that's there's a little sentiment indicator. The pitchforks are out for
exactly.
bankless. Yeah.
Yeah. But this is a great market update. I think to keep the momentum going here, it's going to be a bit of an open mic session in the sense that you've been putting out some great tweets. So we'll speak about those. Another one was related to blockchain economics, really. You've been playing around with the custom chart builder on Token Terminal now that's going to be rolling out for public access, hopefully in a few weeks' time. And
Yeah.
you've been able to put together some really nice composite data points and analysis to accompany that. And one was related to kind of comparing blockchain ecosystems to each other. And I'm emphasizing the word ecosystem because you're grouping together, say, L2s as part of Ethereum and comparing that to Solana and stuff. So I pulled that tweet up here, and then one of Blockworks' researchers had responded to it. Do you want to maybe speak about what this analysis was about and the debate that you got started?
For sure. Yeah. So this shout out to Ryan Connor, a research analyst over at Blockworks. He put out a tweet that sort of like questions this idea of whether people, and I've seen a lot of this going on there's like debates over data between Solana and Ethereum, basically saying you should not be including L2s if you're doing analysis and comparing the Ethereum ecosystem to Solana or another ecosystem. And I'm paraphrasing here, but he basically was saying like, if you think about this in terms of the L2s are basically part of the supply chain for block space. They're not customer facing, so they're basically upstream, and that nobody would ever say that Apple, which is more customer facing, is an extension of Qualcomm, which is sort of providing hardware and software for Apple products. And so if you were comparing Apple's, KPIs and metrics, you wouldn't include Qualcomm in that. It's kind of like what he's saying there. I disagree with this, and I get the take. And you could also just say, hey, L2s are separate blockchains, right? They have separate economics. And so they're just basically like separate companies. And I get why you're saying that, but I just think there's a lot of nuance to this. And my view is that, so I have been including the L2s in my analysis, which is why I was like, all right, I need to respond to this, share my thoughts. And the reason I think you have to include them is because everything to me with Ethereum and ETH, the asset, comes back to like demand for that asset and the network effects around that asset. And in my view, L2s are driving the network effects of ETH, the asset, and there's a bunch of reasons for this. The L2s themselves pay for block space with ETH, right? They're not using their native token. So if you want to do anything on an L2, for the most part, you need some ETH to do that. So like the vast majority of the transactions are paid in ETH, driving demand for ETH. And then, of course, we know that the rollups pay for settlement fees down to Ethereum. So there's an economic tie there as well. The other thing is ETH is the most like prevalent asset locked within L2. So again, like the L2s, are driving demand. There's demand for ETH within these networks. It's the number one like swap pair on L2 dexes is ETH. So it's creating like stronger network effects. I think 90% of the total value locked on L2s is being secured by Ethereum, right? So there's like a clear relationship here. And if you sort of have this view that these are separate, they're separate blockchains, separate economics, that is true. But again, to get into the nuance, like there's many elements here that differ. And one of them is Qualcomm. If you go back to the Qualcomm Apple example, like Qualcomm does not pay Apple or does not provide Apple with millions of users, billions of total value locked, liquidity, all these things that Ethereum provides for like an L2, like Arbitrum. And then the other thing is Apple does not pay invoices in Qualcomm shares, which like that's like a huge distinction there as well. And Qualcomm also does not provide like security for Apple's products the way that like Ethereum does for L2s such as Arbitrum. So to me, there's just nuance here. You could just say, hey, it's a separate blockchain. There's a VC behind that thing. It's a separate economic actor. I think that's true. But to me, the thing that really matters with L1 tokens is like, are you able to create demand for that asset? And to me, L2s are doing that. That is why they have to be included. Maybe like an analogy for this is if you think of, instead of thinking, are they separate blockchains with separate economics, it's kind of more, does one thing drive demand for the other? And I think maybe an analogy here would be like, if you looked at cars and oil producers, does the fact that cars exist drive more demand for oil? And I would say that the answer is yes. And so if you were going to do like an analysis on the oil market or whatever, and the auto industry was growing at the same time, that would probably factor into the analysis of the demand for that asset. And I think that's maybe like an analogy here. But yeah, that's my view. I'm curious, from your perspective, working at a data company, everything, like what are your thoughts? I don't know if there's a right or wrong answer here, to be honest, but this is kind of how I think of it anyways.
I think the way you think about it makes a lot of sense. In general, I do feel that when you speak about like the Ethereum ecosystem and you want to assess its network effects and how it is playing out, how the broader Ethereum ecosystem is playing out, you can't just speak about the base level Ethereum's economics or user numbers. You need to address everything that's going on. But from a data provider's point of view, you need to have granularity in the data, which I think like in this chart that's shared here as well is beautiful that you have like a stacked chart that showcases how different components within that ecosystem contribute to the end metrics. So you can really break that down if you want, but you can aggregate them together and compare that to a more monolithic chain like Solana, because I think that is a fair comparison. You have the Ethereum ecosystem. It's chosen a different way of scaling through a modular approach. And then you have a monolithic chain like Solana or Sui, and you want to compare those two together. The best way to do that is to take that ecosystem as a whole. And you're going to have L2s on Solana as well. So then you're going to include those. Yeah. And the same, in my opinion, goes for Bitcoin as well. If you want to assess general network effects, economic sustainability, and everything of the Bitcoin network, you're going to start including the L2s in that as well. But from a data provider's perspective, we want to provide as granular data as possible, so you can also separate the individual chains and the base settlement layer from it and do different types of analysis. But yeah, at a high level, I agree with the way you approach that.
Makes a lot of sense. And yeah, it's a good point. We're going to probably see L2s on Solana, and this conversation probably shifts. And like a lot of these debates, these are like, it's great to have these, and it forces me to think more deeply about this and what's really important. But at the same time, a lot of these debates are coming from just, I think, people just sort of bag bias. I've seen a lot of pushback on Solana and the data coming off of Solana related to bots, right? Everyone wants to punch down on these charts that show just really high volumes on Solana. And I think that's wrong as well. And bots are economic actors. Like almost like 70% of like TradFi volume is algorithms, and they don't call them bots. They call them quants and algos and things like that. So I just think like some of this is, if it's a wash trading or something like that, yeah, that's not necessarily good. If your blockchain doesn't have bots on it, that's probably a problem. Like I actually think they're like a feature rather than a bug. But I think there's just a lot of noise on these concepts because people are just biased. And if you're biased for Solana, you think that if you're competing against Ethereum and not the L2s, and that's where a lot of this starts, I think. But yeah, I think it makes sense. The way the token terminal displays it now, and these new dashboards are fantastic because you can put everything together. You can see the difference for each actual L2, and then you can also compare the aggregate to any other networks. So,
and we make the data available. Any analyst can take their approach or framework and just pitch it to the world. It's a new space. Yeah. You can start building your own standards. We just want to make the data available. If you only want to include stage 2 rollups on Ethereum into some sort of analysis, do that. We want to empower every single analyst to just do the analysis that they see most fit and just start helping people better understand what's going on in this space, because there's a lot of novel concepts here and things that people won't agree on. So we need these discussions.
Yeah, and I always try to come back to how are these L1 tokens like creating demand for the asset? And the more things you can do on chain through, whether it's through an L2 or whether it's through a protocol or other applications with that asset, you're driving more demand for it. It's kind of like, I've compared it to like demand for the dollar, and the fact that the US has this relationship with Saudi Arabia. And if you're another country and you want to access oil, then you need to convert your local currency to dollars to do that. And that creates lots of demand for the dollar, makes the dollar strong. I think Ethereum and ETH, the asset, is a similar dynamic here, with the fact that you have to own ETH or convert some other currency to ETH to do anything on chain. So the more things that are available within the ecosystem, the more demand for ETH, which I think is good for ETH, the asset. And that's kind of the takeaway on all this for me.
Yeah, definitely agree with you. And we're so early in this space that when you think of a broader Ethereum ecosystem, a lot of the L2s have just launched. They're very nascent startups. Yeah. And the L2s we're going to be seeing on other ecosystems are going to be very nascent startups. A lot of L1s are still very nascent startups. And that kind of builds into one tweet that I also just pulled up here on our side. Intern cooked up a good custom dashboard over Token Terminal. This went somewhat viral, where we compiled kind of the post TGE price performance of all the tokens backed by Paradigm. And the charts don't look too good, to be honest. So of course that got a good reaction from people on Twitter that, oh yes, these greedy VCs are just dumping on retail. That's what they do. But I think the actual takeaway from this, without overcomplicating it, is that startups are hard. And I feel that a lot of people in crypto kind of dismiss the fact that when you're operating an on-chain business, you can just kind of IPO much earlier and with much less resistance than it was in pre-crypto era. So you have a lot of these startups going public that in a more legacy system probably would not have ever gotten to that stage. So this just like really forces retail to also kind of start to grasp that most startups will fail. The post-TG price action for most will look horrible because they've just been in an environment where it's been possible to go public. But yeah, this got a lot of discussion.
Yeah, so I was looking at it earlier. I think there's 20 projects in that dashboard that you guys put together, and there were basically like 3 projects that were up that Paradigm had invested in, and they were like Bitcoin, I think Bitcoin, ETH, and Maker, and then there were like 7 projects that were like kind of like flat, and then there was 10 that were like pretty severely down from like the token generation event. You know, when you think about, like you said, you're investing in startups here. Most like over 90% of startups fail. So that's not that bad. I mean, the charts don't look great when you just look at it first off, but that's actually not that bad. And those are all success stories for Paradigm. And I think that's what sort of triggering people here a little bit, is that they can have a real success story. It's almost like you're doing an IPO. And if that IPO happens when the team and the early investors are unlocked, they can have a great outcome, even though retail does not. And I think that's what bothers people a little bit. But I think on the other side of that, there's also times when like retail is actually able to sort of like dump on like the VCs if the VCs are locked up. There are times when a project just has a 10x or something before those unlocks actually occur. And like retail is basically dumping on VCs at that level. So it can go both ways. I think people get upset about this because they feel like the game can be rigged or something against them. But this is the game you're playing. I think it's really helpful to understand the game you're playing. You are playing with very risky tokens that represent interest, pseudo equity interest in like startups in a new and emerging field. Most of these are going to fail. And I think that's what we see here. So,
and I personally just want to say that I don't think VCs are extractive to this space in any way. I mean, they're the ones backing all the new technological innovations in the early stage. And if you understand the VC math, you only really need to hit one home run. So this is what a VC's portfolio is going to look like, a successful VC's portfolio. You have a couple in the green and the rest are going to be down only. And people just need to grasp that. But yeah, it's great that we have VCs, but there's some very relevant critique that you do see in the space around those lockups and things that probably need some standardization on.
Yeah, and I think we'll see how regulation sort of plays into this, if we see more of this, or how that impacts these models that VCs are using right now. Honestly, a lot of TradFi charts look like those red ones as well. There's a lot of IPOs in the traditional markets that sort of get promoted and there's a roadshow and they basically pump up the price of the asset and then they dump it on the retail investors and they never recover. So this isn't unique just to crypto either.
Exactly. Yeah. And this is just purely like price action based returns, looking at these. But if we go into more of a value investor's mindset, the final tweet that I'm going to pull up here that you put out is more related to, longer term value accrual and distribution to shareholders in the form of dividends. And there's a lot of discussion in crypto about why do a lot of tokens or where the protocols generate revenue or could generate revenue, why do they not turn those fee switches on and distribute those to the token holders? And if they don't do that, are they just valueless governance tokens? So you put together a good tweet again around that topic. So wondering if you just want to walk us through what this one's about.
Yeah, this was kind of like me, like sort of just like putting this out there to say there's sort of like this meme into like useless governance token or worthless governance token. Like a lot of these DeFi projects have suffered from this, where like Uniswap is a pretty good example, where the protocol has lots of users. There's clearly like a breakthrough innovation there. It has product market fit. It does a lot of economics in terms of fees, lots of volume, but there's no actual economics that are being shared with the token holders. There's no dividend payments going to them. the Uniswap DAO is not taking any of those fees and buying back the token or anything like that and creating some sort of value back to the token. And so I think most people look at these things and they're like, well, that's useless. That is a useless governance token or a worthless governance token. I wanted to sort of just put this out there and say, well, if you think that that's useless, what do you think about, the 50% of stocks out in the market that don't pay dividends? What is that to you? Is that a useless? Does that mean it's worthless because you literally just own a piece of paper or that's been digitized that represents some ownership? In the crypto case, you have sort of like this pseudo equity. There's no legal requirement there or legal relationship there. And this was good. I mean, I got a lot of interesting feedback in the comments on this, and lots of people were sort of like shitting on me. This is the dumbest thing I've ever seen. And they would basically say, you can't compare these two things because of the fact that equity holders have this legal relationship. And if you own the stock of a company, you have liquidation preferences if the thing goes bankrupt. If you're a common stockholder, your liquidation preferences is behind the bondholders and the preferred shareholders. And so my question on that is that why you buy stocks? You buy stocks because you get a liquidation preference, or are you buying it because you think it's going to go up in value? Because things like Google and Facebook have been around for 20 and 25 years. They just started, issuing dividends this year. Amazon still doesn't issue dividends. So anyways, it was kind of like a way to force people to really think about this. The takeaway for me is that is like the key difference. And it actually doesn't really matter because people don't buy stocks because they get liquidation preferences. I'm pretty convinced of that, even though they think they do, based on some of the comments that I saw. But to me, the takeaway is like, this is a social construct and it matters. It still matters to people. A lot of the comments were basically saying that if Uniswap did buybacks, that would change their view on the token. So you don't necessarily have to do a dividend payment or share the fees. But if you're doing something like what MakerDAO does, where they sort of buy back the token with some of their earnings, like that would work as well. So that's like a key. I think that's a takeaway if you're building in the space. Like, people care about this, and for sort of governance tokens to start to have value similar to shares in high growth tech stocks that don't pay dividends, we need to sort of break this social construct that's sort of out there around this currently. So that was kind of my takeaway was, this is just how people think right now, and it does matter. So as an investor, I got some good takeaways from the comments on this.
Yeah.
Yeah.
I think it was from Jupiter said that every single token is a meme token, and that kind of similar to the fact that valuation is just a social construct. Everything's a social construct. And for these protocols that have actual business, the way that you control the narrative is with the data. So you have the data on the fundamentals that helps you control what the social construct ends up being, or the social consensus around what the valuation should be. And for memes, it's just something completely different. But everything is about narrative.
Everything's about narrative, exactly. If Uniswap came out and said, hey, we're turning on the fee switch, or we're going to do buybacks, like, I guarantee you the price of Uniswap would rise pretty quickly, and then that would start to impact like competitors and like how they think about it. Then you would see lots of that. I would expect to see a lot more protocols start to do that. I think they're not doing it currently because of the sort of the regulation overhang there. But then all of a sudden, okay, now that becomes a social construct, essentially. We sort of form consensus around how these protocols are going to sort of not only monetize, but sort of drive value back to the token. And then that's how the market starts to price these things. But we're kind of not there just yet.
Exactly. But you do have to admit that there is a bit of confusion as well, because you have a lot of these companies, they have the labs entity that is typically off-chain and there's equity involved. And then you have the on-chain entity that has the tokens, and we just don't yet know how the actual value will distribute in situations like, in M&A or some sort of liquidation events.
Lot of question marks. I think it's a great point. And what concerns me about what Uniswap is doing there is I don't think you can have value. You have to pick one. You can't really. The equity investors all received tokens pro rata, right? So that is where I believe these even their equity investors expect the value to accrue. But then at the same time, they have monetized their interface, which is direct, that is driving revenues to the Uniswap legal entity and not to the token holders. That is a major conflict of interest. I don't think you can have that because people will just not buy the token. If they start to see that happening, why would you buy the token? You have to, they need to sort that out. I think this is related to regulatory overhangs, and maybe they're just trying to figure out what they can monetize, what they can't monetize. But I don't think you can have these like two cap tables. It's just so confusing for investors. So
it definitely is. I've been following a couple of processes where, because I'm a venture partner in my like generalist VC fund, where we've invested in the pre-seed or seed stage of a company that's then pivoted into Web3, and now they're doing like the TGE, the token generation event, and you have the off-chain entity in one country, and then you've kind of organized an entity that is legally capable of generating a token that is in no way basically tied to that off-chain entity, but then there's still some sort of value accrual deal between them. It's a complete mess, and I don't think there's any standards or clarity in terms of regulation around how you should be doing it. So understandable that people have question marks.
Welcome to the Wild West of crypto.
Yeah, I think that's a good note to actually end this one on. A good open mic session, great tweets that you have been putting out, facilitating some really important discussion in the space. Glad to see that it's also a discussion where you have a lot of other smart folks who contribute and give their takes. So I feel like everyone's learning when reading that stuff. So keep it up. And next episode here, we will have a guest on. So that's going to be exciting. Speak a bit about the Solana ecosystem.
Yeah, we can leak that, I think. And likewise for Token Terminal. Token Terminal's Twitter has been hot as well. There's these new dashboards are awesome, and I can tell people are really engaging with that. So that's awesome to see. Yeah, so next episode, we're going to have P. Lee, who is the head of Sanctum, doing some really, really interesting stuff in the liquid staking market over on Solana. This is a sector that I've kind of had my eyeballs on for a while. We've covered Marinade Finance and the DeFi report. I think readers will remember that. My views on liquid staking sort of setup over there have really been changing, and Sanctum, I think, is a really big player in this space. So excited to have FP on. We're going to go into all those details in a few weeks. So hopefully people tune in for that as well.
Definitely. Thank you everyone for listening. We are back on track every other week. Be pushing out an episode of The Signal. Thanks, Mike, for all these insights.
Thank you, Oscar. We'll see everyone in a few weeks.